this financial independence for women and Kodeeswari. It can be a discussion, and it would be very helpful. Like if you can, we can enable your mic also, and all your questions can be answered here. Like any doubts you have, whether it's regarding investments or anything that related to personal finance, any doubts that you have, that can be answered here. See, the point of this webinar is to make us understand why we know that women are high savers. We know that women save well. When it comes to investments and creating wealth, are we still behind men, or are we still behind a lot of our peers also? That is an important question we need to answer. So we need to understand why financial dependency uh, is not is something that we need to look into, and why financial independence is very, very important, especially for a woman. So this session tries to address that concern, and moving forward, we will also discuss how we can generate our own wealth mission through Kodeeswari. So, Kodeeswari, as you all know, that we started this program in Milestones to Wealth, women, handling women investors, providing, clarifying their doubts, making them invest in a way that the wealth compounds. At the same time, women also understand what they are doing, and why they are doing it, and why it is better from usual traditional investments that we do. So it's very important to understand why we should invest now in via mutual funds to generate wealth, and why we shouldn't be only relying on gold FDs, the traditional investments that we usually do. Why this modern investment is mattered at this point of time. Before we start, let's address a few financial problems. See, whether we like to bear it or not, these things are going to be present. Either we are currently dealing with this, or you might have to deal with it in the future. So when we look into it, the common financial problems that women face, the immediate one that we get is basically family commitments. And there are existing debt that is going on. Maybe you'd have bought a loan from a self-help group, or you'd have bought a loan for your small business that you're running in, or maybe a family, you have taken a loan for like home, for car and all that. So there is also existing debt, and this is where this personal loan and credit card debt also comes in. And with all these common problems we face, we forget one thing, that we don't have an emergency reserve in place, which will help us in this kind of financial trouble or any emergency situation. Do we really have a emergency reserve in place? See, all of us have this common financial problem. This is irrespective of a man or a woman. So these, when we look into it, see, for example, in the last webinar also, we spoke about one of our client, and in various conversation, we mentioned her that, see, she was a teacher. Her husband, was not actually, providing her with providing the family with enough financial support. So she is actually taking care of the family, but at the same time, she is doing, she's actually aggressively saving for the children's future, so kids' education. And her retirement is also very crucial, because she's a teacher from a private school. So obviously there won't be any pension when she retires. So all this, family commitment, plus she has some credit card loan that was going in when we met her, and there was no emergency reserve in place. The first thing we said her is to have an emergency reserve, and then start with the investments. So that doesn't mean that she has to save only. If she has good savings in FD, and we try to understand how much can go for emergency reserve, and we helped her actually allocate the rest of the money in better way, so that the wealth is being created. The idea is that, she has some gold also in place. No wonder, like, all of us first think about having a gold investment, and then only we next move to the other things, other asset classes, right? So there it was also there. So what we said is she had enough exposure to gold, enough exposure to silver. So sorry, enough exposure to FD. So now we should move on to creating wealth. So creating wealth asset. See, what we usually, when we address the Kodeeswari clients, we usually say financial independence comes out of, having enough corpus to meet all your goals, as well as there is enough, enough emergency reserve in place, and you are well protected, as well as the wealth is also compounding at a good rate. So where the problem is really happening, all the traditional investments that we do is not allowing us to think beyond inflation. So inflation is happening everywhere. Like what, for example, a particular, maybe even we can look into the day-to-day grocery also. The thing that we bought last year is actually, the prices are rising, right? So every year the price keeps on rising. So even when we take a particular goal like education, when we studied college, the we can compare the fees when we studied college and how kids now going to school when they are in KGs, we are spending a lakh every year. So the inflation is a real thing. So what we need to do is we need to invest in such a way that we beat inflation and we create wealth for, or when we have enough corpus to meet these goals. So you think about investing in a way that you are meeting the goal without thinking much about how we are going to finance this particular goal. So that is what all this is coming in. Either it is emergency reserve, or you have any big purchases like house, or you want to buy a car, or it is about your children's education. See, for all these goals we need money. So earlier planning is very important. At the same time, when we take good vehicles for investment, that will also help us to reach the goals on that timeline. And at the same time, we don't need to worry about where are we going to funding this goals.
So, like she said, uh, there is a lot of financial stress that comes, with being in such situations, right? And it sort of fractures the entire family, right? There's going to be so much anxiety, so much fear, and so many arguments, but everything just falls apart because of one sudden emergency, right? So the truth is that you need to take charge of your finances today, not tomorrow. The best time was definitely yesterday. The next best is today. So make sure that it doesn't take charge of you, right? Financial independence is not something selfish. It's not about you hoarding money. It's not about anything selfish, right? It's about securing your family's future and your future, and more about ensuring that if something happens to anybody, none of the other dreams or aspirations will take a backseat. It's about the real freedom that you want to enjoy, right? So the question ideally should be, should I manage my money? The answer to that is yes. And the next question should be, how do I start? Right? Next, we'll talk about the gold trap, right? How many of you here, you can feel free to put your answers in the chat box. How many of you here think that gold is the best investment ever? India's women own about 130 plus lakh crores in gold, right? And we call it investment, right? That's almost like the entire GDP of most countries, right? That's the wealth that you, me, every woman in our generation and previous generations have accumulated. Now, when you and I talk about owning gold, we call it an investment. We very casually call it an investment. We say that, my gold is a great investment. I'm building wealth through gold. But a question that a lot of people fail to ask is gold really an investment? Or is that the best investment there ever is? Think about it, because an investment by definition is supposed to do certain things, right? It should generate income, it should grow over time, ideally beating inflation, like she said in the previous slide. It should be liquid, meaning that when you need it, you should be able to access it, right? Now look at gold with the same lens. Does it generate a monthly income? No. Does gold give you a dividend? Does it give you returns every quarter? Right? The answer to all of these questions is just a blanket no. It just sits there. But of course, it does look very beautiful on you when you wear it. But is it really working for you is the question that you all have to ask. One more interesting aspect is emergency value when it comes to an asset like this, right? Let's say an emergency comes up and you need money urgently. Do you go to the pawn shop and sell your gold? That's probably the first idea that comes to you. But when you do that on an urgent basis, you don't get the market rate, right? You get what the jeweler decides to give you at that point in time. So you lose about 20-25% in the transaction right there. So you don't even reap the actual value of what you had invested. And growth, I think, stays stagnant. Now there's a lot of talk about the precious metal space, gold and silver. We saw a drastic dip yesterday. That is, of course, there's a lot of market volatility that comes with it, and it's purely speculation and exuberance from the side of the investors. But when we look at it from a traditional point of view, let's look at it, say, 25, 30 years ago, that 7% people were happy with. But it's just about keeping pace with inflation. You're not getting ahead. You're basically running in the same space without moving. Right? So the conclusion being that, yes, gold is not bad. There is a lot of cultural significance that comes with it. There's a lot of emotional value, and people consider it. Certain people think of it as a status symbol, and they like to don gold jewelry, silver jewelry, but it's just not good enough anymore. And not if you're thinking about becoming financially independent. It can be one of the components in your portfolio. It can be one of the asset classes, but not the only asset class in your portfolio. Right? That's why we call it the golden trap, because we've sort of been caught in that golden age, right? Even even when we didn't know that the door was open, right? Which brings me to the next slide. This is just a little bit of math that you all can see, right? And this is not math that we want to exaggerate. This is very simple and very realistic math. Say every month you set aside 2,000 rupees. It's 2,000 from whatever you get, whatever you're able to make. You set aside a portion. Let this even be 1,000 for that matter. For some of you, that amount, that 2,000 might be one less dinner or one less movie outing that you take, or maybe like one skincare product. It's not a fortune. It's not a life-changing amount. It's 2,000 rupees that you should definitely think about setting aside for investments. Now, you say you put this into an SIP, a systematic investment plan, which means you pump in the same amount of money at regular intervals, ideally monthly, right? And let's assume that you generate 12% per annum. No magic. We're averaging out all possibilities over here. It's pretty standard. So when you do that 12,000 per month, in 5 years, that grows to 1.63 lakhs. In 10 years, 4.6, close to 5. And in 15 years, you have 10 lakhs. And this is only if you do it consistently every month, right? Now take a quick pause and read those numbers again. It's 10 lakhs, like just from 2,000 a month. It's not luck, and you've not put your money in any let me get rich quickly scheme. It's just the power of consistency and the power of compounding, right? And what surprises me even more is that so many of us hear these numbers, but we still don't act. Everybody says, yes, the math is really nice, but it can't be real. But what we're showing you is actually real. It is compounding. It's the time that you participate in the market, and it's the discipline that builds you this amount of wealth. And the reason a lot of us don't have that is that's not because we don't earn it. It's because we don't start. We wait, we keep waiting, and we keep waiting for the perfect time and the perfect amount. And we wait until we have enough to invest. And by then, I feel like we would have lost so much of our time in the markets. You would have probably made 50 lakhs, but you waited so long that you're still struggling to get past your 2 lakh or a 5 lakh milestone. Right. So I want to put forward a very friendly challenge with all of you today. Start with 2000, start with 1000 if that's all you can do, but start. Right. And like I said, I keep reiterating this in multiple webinars. The best time was yesterday, and the next best is definitely today. So now we saw how important the power of compounding is and how this multiplies, right? But one thing that you like, a concept that you should maybe keep in mind is my wealth growing linearly or is it compounding? That's where we bring in simple interest and compound interest. I think the last time we all heard these terms was in school in class 7, where we did simple interest and compound interest. Like, so there are two simple ways in which your money grows. I would not say that these are rocket science concepts. These are fairly simple to understand. In simple interest, your principal sits there, it earns interest, that interest gets added to your account, your money grows linearly in a straight line. It's predictable. So can I call simple interest boring? Yes, for sure. Now, compound interest is where the magic happens. Your principal earns interest. The kicker here is that the interest also earns interest, right? So it's like you have babies, your babies have babies, and so on and so forth, right? So your money doesn't just grow, it accelerates. So when something accelerates, it goes faster. And we are not trying to sell something that's not real. These are numbers that are very, very real, right? So if simple interest grows in a straight line, compound interest grows like a curve. And the longer you wait, the more dramatic your changes are going to be, like we saw in the previous slide itself, right? So this is the exponential money that you're able to grow over time, right? And the crazy part here is that most people understand this concept very intellectually, right? But they don't apply it to themselves. They don't live it. They leave their money in very low return aspects, barely earning something, when they actually could be exponentially building wealth. So trust me when we say this, that the math does not lie. Time plus compounding interest is what equals your real wealth, and discipline, of course. It's that simple and it's extremely powerful. So what you have to do today is start. That's your cue. Again, we have some numbers to show you. There's somebody who's able to do an SIP of 25,000 and is stepping up by 10%. Stepping up as in every year with whatever incremental income I get. Say I get a bonus of 10,000, which means my salary becomes 35, right? So you're doing 25, you have gotten an incremental 10,000 and you want to increase your SIP by 10%. So 10% on your 25,000 will be 2,500, which means the next month your investment is going to be 27,500, so on and so forth. We're assuming conservative return of 12%, and we are sort of showing you the same time horizons, 5, 10, and 15 years. So look at the difference between the amount that you've invested and what the current value of the investment is going to be. In the first time horizon, you're seeing a 6 lakh difference. In the second, you're seeing almost a 40 lakh difference. So there's like a double. Your money has doubled in a gap of 5 years. In the next gap of 5 years, from 95 lakhs, your corpus has grown to 2 crores, which is again 2.5x of the corpus that you have invested. This is really not math that you should think that we are lying about. This is real. We have been able to build portfolios like this. So many people, we've helped so many people reach so many milestones for that matter. And I think even a lot of them are on their path, on their journey to build their first crore. So if you are ambitious and you want to build your first crore and you want to attain milestones in life, this should definitely be your start, right? Just let it run on an auto debit. You decide on an amount that goes out every month. You don't think about it. You don't second guess it. You let that money work for you without even overthinking. And whenever you have the opportunity, you can also do a lump sum. You may have a bigger chunk of money, maybe a bonus, or maybe some gift that you got out of a family gathering, right? You deploy it strategically, which is why we are here to help you as advisors. And by doing a combination of SIP, step up SIP, and lump sum, that's the real magic. You do this and you may get your goals even faster. It's not to say that this is the only route. You can do just SIPs also, but it's just how disciplined you are, what amount are you going to be doing, and how fast do you want to get to your goal. If you have the answer to these three questions, you are going to reach your milestones before you even know and realize it. Right? Like I said, SIP, step up SIP, and lump sum. This is the ideal combination, but I also do understand that not a lot of people will have the luxury and have the cash flow to be able to do this. So let's start with the first step on the ladder, which is an SIP. Just set aside a certain amount that goes out every month and you forget about it. Let it not become a habit for you to say that this month I will not be able to do my SIP because I have some other commitments. Let's work around a situation where this happens and that also happens. Okay, let's talk about one of the most important principles that you will ever learn, right? It's quite simple. The rule of 72. Now, once you understand this, you probably might not even look money in the eye the same way. So the real answer to this rule, right? What this rule really gives you is how long will it take for your money to double in value? That's all. It's very simple. You do 72 divided by your interest rate. That will be equal to the number of years taken for your money to double in value. Again, let's go back to that 12% example. So 72 divided by 12. So whatever amount you have invested in 6 years at 12%, your amount is going to double. Your investments are going to double. So your money doubles every 6 years. That's the rule. So if you say invest 10 lakhs today, in 6 years it becomes 20, in 12 it becomes 40, in 18 it becomes 80, so on and so forth. Like, this is not any hope, this is not any theory that people go around flailing. This is just simple math, and this is compound interest in action for you. This is the real math. Now imagine if you started this at 30 instead of 40, or 25 instead of 30. The difference in wealth is going to be so staggering. It's going to be such a drastic difference that you're seeing in your wealth building journey that you end up repenting or regretting that, oh, should I have started earlier? And that's the real problem that we're here to solve. We don't want anybody regretting or saying, you know what, I should have started earlier, but I just didn't know. We are out here trying to educate so many women that it's important for us also to be able to stand on our own feet.
So yes, as we discussed, this is a Kodeeswari blueprint that we have been talking about. Like, we need an emergency fund so that we don't dip on our savings or investments while there is an emergency. And there should be term insurance and health insurance for the family. Term insurance is especially if to the breadwinner of the family, if your husband is a breadwinner, or if you both are working together, and taking care of the family, then even a homemaker can take a term insurance of up to 50 lakhs that she can take. So why term insurance is very important? Because as we all know that life is very uncertain. So if anything happens to the breadwinner of the family in that uncertain position, you will receive the corpus. The nominee and the family will receive the corpus that can take care of the financial burden of the family. Because the breadwinner is no more, there is a lot to figure out. There is a financial burden as well as emotional burden. All that can be, at least the financial burden can be sorted off by having a term insurance in place. So even a homemaker definitely can have a term insurance of 50 lakh and health insurance for the whole family. This is very, very important because a simple hospitalization of like 1 day or 2 days is costing us 25k to 50k easy. So at this point of time, where as we all know, even now we have a recent stat which is saying Tamil Nadu is basically having a lot of diabetes cases. So when there is diabetes, then automatically the the risk of having heart related ailments and all that is very high. So it's better to have a health insurance of at least 10 lakhs if you are a family of four, you, husband, two kids. Or if you and husband is only there, if you both are only there, then at least a 5 lakh health insurance policy is very much necessary. See, even if you are working or if you want to take a decision alongside your husband, when you think about it, one problem is that if you are working in a corporate, you will be covered with the company provided insurance. But with the health, the problem is that the sum assured, meaning you are insured only for 3 lakh or 4 lakh maximum. So it will not be enough to cover in case of any critical illnesses. So it's better to have a standalone private health insurance for the family. And then decide why you need to invest now. It's either for your retirement and for a dream fund or for child's education. So you can decide a goal and invest for that. So I think when you have a goal and invest towards that, there is a specific timeline in which the goal will come, and you are actually doing an investment to reach something. So as we save for in case of emergency, this investment can be mapped to a particular goal. So we will realize over a period of time, let's say if you have a girl child or boy child, and they are in their first second, or they are in below fifth, and you really have around another 6 to 7 years or 8 years before they reach their college. So you can actually save up to 10 lakhs or so, meaning if you invest properly, and that, as Aishwarya in the previous slides clearly mentioned, if it compounds at 11% rate also, or 12% rate also, you can actually build a 10 lakh corpus for your children's higher education. So it's better to have a goal and invest towards that goal. And you have to regularly track it. So let's say every year you are going to put some money for the goal, for that particular goal. For example, let's assume you want to, as I already told you are going to invest for your children's education. So you want to actually have around 10 lakhs in place before the children get into a college. So how you can plan is that, so let me share my screen to just to give you an idea how this can be done. So let's assume that let's take 12% and you are looking for children's education. So children's education at around, it is coming in another 8 years. So let's say you are investing around 10,000 SIP every month. So at the end of the 8th year, you'd have invested around 9.6 lakhs, and the growth, as you see, is at 12%. It's around 16.49 lakhs. So around 17 lakhs you'd have made. If the returns is much better, you'd have even reached somewhere around 20 lakhs also. Meaning what you have invested is actually doubled over this period of 8 years. So if let's say we are not just going to stop there, let's assume that you are putting some amount as a lump sum investment, like as Aishwarya also pointed out, like you'd have received some bonus, you are thinking how to invest that, or you just got some money from parents, or any other source of additional source of income or savings that you want to put. So let's assume you are putting some 1 lakh as a lump sum on top of this 10,000 SIP. Then you are already there in a 20 lakh. Or if it is 2.5 lakh, then you are around 23 lakh is what you have, in the future you would have received. So it's not just working on the math. Working on the math is just to give you an idea that if you do it this way, even at a very conservative rate, we would have got this much money. So at a 8 year, you can actually build your 25 lakh corpus. So if you properly invest, see, okay, I understand if let's say you don't want to start with a 10,000 SIP, even if it's a 5,000 SIP, you are still there. And whenever you get additional money, you can invest whenever you get additional money. So if that is the case, you can still do the same. Let's say I just put 1 lakh here, you can still make around 10.99 lakhs, meaning this 10 lakhs can be for your children education, can be from a 5,000 SIP with 1 lakh as a lump sum investment. So this is very much possible. As you see, you would have invested 5.8 and it is grown to 10.99. So your money is actually doubling at a period of 8 years. So this doubling is not happening in all the asset classes that we are saving right now. So at least you can withdraw this money and you can go ahead with your goal. Similarly, the idea is here is to understand that what we can do with our savings. We can do this much with our savings, but we are actually underplaying, right? So what we need to do is have a goal and plan for that particular goal. What do you need to do when it comes to a goal? The goal has to be very specific. Okay, I want to save for my retirement. I want to save for my kids' marriage. I want to save for my kids' education. I want to save for my vacation, or I want to save for my own enterprise. Like I want to start, I want to be an entrepreneur. I want to start my own business. It can be anything, but it has to be very specific. You cannot say, I'll just save, I'll just put it here, let it compound. I'll try with 1,000 rupees. No, no need to try. You can clearly have an idea and go ahead with a solid plan, and that's where we will be helping you out. So have a goal. That is point one. Second, have a timeline. So obviously goal comes with a timeline, right? So if you are the family is going to retire, you know that around 12 years, you will be, you may not work after 12 years. So maximum I can extend up to 12 to 13 years. And kids education is at so and so years, like maybe around 8 or 9 years, their marriage will be coming. So have a specific timeline. So there is a goal, there's a specific timeline like 8 years, 9 years, 10 years. So this kind of timeline is there. And then think about how much you can do and how this can be mapped to this. So these two portions we will be helping you out. All you need to have is to have a goal and to have a specific timeline and how much you can save for this particular goal. These three are the inputs that you need to provide us so that we can help you with how this savings can be tuned into a good investment so that you will reach that particular goal and how much this investment can help you reach. So how much this investment can actually help you make. So all that we can discuss and we can provide you with good mutual funds that that we are already doing with, and then we can go ahead with. So we are not telling here to stop your existing investments or to stop your existing saving avenues like gold or like FDs. That is totally up to you, but think about a long-term goal and create a wealth for that long-term goal through a proper investment platform like Kodeeswari.
You can always get in touch with us. Thank you all for joining us today.